Good day. This is the Eye of the Storm podcast with the big picture update, technical picture update for the U.S. Treasury markets on Sunday, June 11th, 2023. I'm beginning here on the rate chart. So that would be the interest rate, but this is based on the U.S. Treasury securities at a 30-year constant maturity. So it's quoted on an investment basis, not on that constant basis that we would get each day from the 30-year bond as it moves higher and lower on a daily basis. So this starting here begins to form a picture of what may start to happen as soon as next Wednesday when we get our the next Fed decision as to raise rates, pause rates, or whatever else comes in between. So beginning here, what it begins to tell me is a fairly compelling story, or scene, I should say. And that is that I have been counting in the 30-year bond, and then consequently here in the rates, a five-wave structure. Now that five-wave structure in terms of rates is that rates are going up versus with over in the bond itself, the futures market, the bond price is going down. So where we've sit in that is that we've hit that wave 3 high in rates and that wave 3 low in bond prices, and continue to form and work our way through a minor fourth wave. And so within rates, it's holding it right in a what I'm seeing form as a triangle pattern. So it's not really moving the rate to a higher level, breaking above what we've already seen in terms of the high of wave 3. And it's not pushing it below the level which we've seen at the start of this wave 4. So counter trend correction in terms of the rate. So it's lower rates for wave 4. And that would go along with, in a wave 4, higher rates, higher bond prices. Now, let's just take a look. If indeed this is forming a triangle, as I'm showing here, the first scenario that I have is that we have wave A, wave B, wave C, wave D, and we've just begun to form wave E. Now, granted that on an investment basis, the rate sat at 3.97, while the 30-year bond future fluctuated between like 126 on the bottom and 129 plus on the top, and moved back and forth with incredible volatility over the last several weeks. So what does that begin to tell us? First of all, the bond, the 30-year bond, which I'll go over in just a minute, is really struggling to determine where it needs to be to correctly reflect what that Fed decision may or may not be. So that's the confusion that I think is happening over in the physical futures market. Now here, it's kind of could be telling me two things: that we started to decline. Now, if indeed this E wave is continuing to form, what is the potential? Well, its full potential could be that it could come down to, on a rate basis, since it's close to 3.87, and that would be as of Friday, 3.87, that we could drop still to 3.67 to form wave E, and then again to set the stage for a much stronger thrust up and out of a triangle pattern. Now, what would break the triangle pattern is if the market moves and drops below 3.67 and maybe even got down to 3.5. Now, these are the potential against what the market's trying to do. But right now, at least on a constant yield basis, I'm using the constant maturities, it's not actually indicating that. Because I would think that the rates would move lower quicker. So here's one other interpretation. Still using the possibility that we are and have formed a triangle pattern, that we have A, B, C, D. Excuse me, we could have A, B, C, D, E. Now that all coming out very quickly. Now, if wave D ended here, then what we've been witnessing is the thrust up and out of the triangle. Now, let me show you something. Again, if I have to remove this particular boundary for the triangle and I reinstate it, and I put it here, the thrust out happened back in May. So you see that what could be forming, here's the other side, right? If we have completed the minor wave 4 in the rates, remember, minor wave 4 is going to show lower rates, higher bond prices. Keep that in mind so when I switch over to that bond chart. So now what we have here is if it completed that move, then what we have going on is that thrust out. And that what we're forming is a minor fifth wave. So what do we have? Waves 1, 2, 3, 4. And now we're going to thrust up and out again in a fifth wave. Now, if that fifth wave comes in any form like it did here, 3.71 to 3.97, that's 20 to 25 basis points. 20 to 25 basis points from 3.87, even if I use 0.25 or just a quarter, is 4.12. We need to get above 4.25 to complete a fifth wave. We could be well on that way. So what does that tell us on the possibilities of what could come next Wednesday? If this chart is telling us anything, it's suggesting that we might launch higher yet again. Now, again, if I move the boundary and put it up here, it is suggesting that we might get that pause. So you can see how the rate chart itself leaves both potential with an equal weighting. Now, let's bear that in mind. So we know if the answer on Wednesday is they're going to actually stick to their plan and raise the interest rate 25 basis points, it's going to throw some immediate turmoil into the bond market and likely into the equity markets and across all of the sectors, because the market's been so hell-bent on sticking to they're going to pause, they're going to pause, they're going to pause. They have to pause. We got to pause, et cetera, et cetera. We're in a new bull market now. So all of this other stuff's been taken care of. Whatever the scenario is, let's stick to the facts. So on a technical basis, I have a compelling picture that can show me that, nope, we probably have reached the rate low for right now, and that we're likely going to get a hike in June, and possibly an additional hike before September. So that's the scenario that could push us to complete this minor fifth wave up in rates. Now, I'm going to go over quickly, and again, we're going to try to stick to the technical picture here. So let's go over to the 30-year bond. And again, I'm going to be using the daily chart. I could go one higher to the weekly, and let's just double down and go over there. So what I'm showing here that you can see here is that what I have is, this is an alternate. So what if within its fourth wave, the bond market, the 30-year bond, is basically giving us the same choices in terms of either wave 4 completed at the April high, the beginning of April, the high in the bonds, which was 134.14. Right now, it's via the September contract. 134.14. And so what we're starting to do is to drop in a minor fifth wave, which will consist of 5 waves of minute degree. We're getting ready to drop in minute wave 5 to finish minor wave 5. And that would suggest that we're going to drop, and we should drop below The current low, which is registering at 117.19, basis the future. And if we look at the September contract by itself, it's going to be a little bit higher. But on a constant basis now, right? A continuation chart, which is what I'm looking at here, it's going to be that we need to drop below 117.19. Now, what is the alternate count here? Is that minor wave 4 is still in progress. And what we have is, like in the rate, we have a triangle pattern of which we've completed A, B, C, and D, and we're going to thrust higher in an E wave, but likely be held to the boundaries. So what high could we get? Well, likely maybe right back to that 134 level, 134.17. If I kind of bring it out and we're sitting here, what do we got? 134.21. So we don't really break anything, and we actually don't even need to get there. Wave 4, if it's going to triangle, should come in a little bit lower. So we have 132.30, which is where on a weekly chart, the weekly 50 EMA comes in. Now, if I drop this down to the daily, it might clean it up just a little bit. Now, my current count shows that wave 4 is complete. So back to that, we are dropping. So what is all this noise that we got here, including this thrust up and out? That was on the pause statement. That was on all of the rhetoric that came along with that. And so the bonds ran up to a high of 129.16, I believe, on this day. Well, according on the September contract, it was 129.02. That was that high. And then has been extremely volatile ever since. Now, here if we looked at the cash market, wave 4 did not overlap wave 1 in the cash market. Okay, we overlapped slightly here in the futures market. So we allow that on the basis that we compare cash as well. Now, what would that say? That we're getting ready to really drop very strongly in a minute fifth wave, which will ultimately, here we have that September contract low, you can see is at 118.13. On the weekly basis, we have 117.18, but we'd be looking for a pretty strong drop up and out of this. And that could be actually to where we have two scenarios where the third wave is still in progress. And we have 1, 2, 3, that's the 4, and we have the 5 to complete the 3 here, get a 4 and a 5 to complete the whole picture. I'm giving the benefit of the doubt that it's going to come out in wave 5, and wave 5 will also be the more extended wave. So that is the 30-year bond. We have two very distinct views, one which would include a thrust higher, and then the other to thrust lower. And now we understand how those would come into play, either on the triangle basis, if we get a little bit of a pop higher in an E wave, right? An E wave up, we would see rates go lower. They will continue to drop and possibly eventually get themselves down to 3.67. So we've been there before, but what that equates to in the bond price is back above 130, or at least above 129 to 130. We were at those 3.62, 3.67 levels here at 134. Can we get back there? We can. We definitely can in the alternate count. Now, if we get that surprise to the market in terms of we're not going to get a pause, that inflation is continuing to be strong and stubborn, and they stick to their plan. Interest rates are hiked 1/4 basis point, or possibly even more, that would be the shock, then we're going to see this thing turn. Because what we've seen, even if I bring this back down and we took a look at the hourly chart, well, let's just take a look. This volatility, right? This was on nope, not going to happen. This was like, oh, yep, it is. This is like, nope, yep, nope, yep, yep, nope. So we're getting this volatility in the third-year bond, which isn't really telling us anything. It's telling us confusion. That's what is there. Because on top of that, we're getting strong moves in the equity market. So you get a lot of flight to quality type moves. So a lot of stuff going on, all within a tight range. Now let's take a look and then go over to, let's take a look at the 10-year note. Want to quickly do this to kind of show you it's happening across the board. I'm going to come back out here to at least our daily chart where I have things labeled out. Each one, our 30, 10-year note, 5-year note, are showing the same possibilities within the pattern. In the 10-year note, we still could have that triangle pattern going on. That's being represented here with these, and that would suggest that wave 4 is not complete yet. So we're going to complete that and still come quickly lower and break below this low, which is at 109.130. That's on the daily chart. So what would that suggest? Well, we're in A, B, C, we're in wave D, completing wave D here, and we're in wave E, which now would suggest a pop. And what are the limitations? Well, the top of the triangle boundary or trend is 116.285. Well, our April high was 116.045. So maybe it pops a little bit above, but it doesn't even necessarily have to get that close. Well, it could get up to 116. And then what would happen at the end of that triangle? A quick reversal, a thrust out of the triangle. This is on a daily. So we might get the initial start of it, and it could take its time or then on just working its way higher. Because remember, the triangle pattern will thrust out of the triangle when it's complete. Doesn't necessarily have to thrust up in a wave E. Now, that would be the alternate count that I have thus far. If I drop this down to my, at least even a 4-hour chart, it's seeing pretty clear that the volatility, while strong in the 10-year note, is not moving it in all directions as it is in the 30. It's been more with a downward slope. So that keeps, on my daily chart going back, that keeps this high being the ending point for that minor fourth wave. And then what we have is 1, 2, possibly 3, but maybe not. 1, 2, 3, 4, and we're doing 5 to finish 3. We get a 4 and then another 5, which then brings us below that low. That's the picture building in the bond market. A little bit of confusion, but we've got it covered. So in essence, even though we may get that pause, it'll force the upside in bond price, downside in the rate, it's going to be short-lived. So the longer-term picture, the longer-term view continues to suggest higher rates, lower bond prices. Over in the 5-year, it again is the same thing, but here we are one more time. Let me go one more up to the weekly, maybe we can see it. Okay. I'm putting the A wave as complete here. So in the 5-year note, I'm leaving this as out, that the B wave is showing us that we have an A, B, C, D, E, and a thrust up, an A, B, C, D, E, and then a thrust lower. So it's going to be a move higher in the note price, and then the rate, the 5-year rate coming down, the yield, and then completing the triangle. And again, where can this triangle complete? Well, we're back towards that 111. What's the high thus far? And again, that goes back to, actually, if I had to go all the way back here, end of March, no. I'd have to go to the beginning of May to where we reached 111.112. So that's the high that we saw on May 1st. So if we're here and we're doing A, B, C, could this be the completion point for D? It might be. And then that meets this, and then we move higher in an E wave, and then we thrust lower later. Again, yield rise, bond price decline. So everything seems to be lining up that all the markets remain in somewhat a state of confusion. And we're looking for the market to actually begin to tell us what is coming next. But we're waiting on the Fed. So I would suspect that Monday and Tuesday are going to continue to be confusing, may tighten up. We may get a little movement in one way or the other as traders become more convinced of what actually is going to happen. Don't forget that we also have CPI and PPI next week on Tuesday and Wednesday. So before the Fed. So I'm trusting that the Fed already has these numbers. So we may get traders making a stronger suggestive move based on CPI and PPI. If they both come out with an improvement in inflation, they're going to go for the pause. I'm just going to lay that out right now. If either show that inflation has reversed and is not continuing to decline, then they're going to go for the rate hike. And this is where I'm going to complete this portion. So this is the completing portion for the U.S. Treasury markets. Thank you for listening. Our next update will again be on the next Eye of the Storm podcast.